excited about this next panel. We started this panel, or this session last year, around civilian VCs coming to give advice to military veteran founders. We found that in our previous conferences, we had a ton of military veteran VCs come talk, but it's not just enough for veteran VCs to invest in military veteran founders. We also need civilian allies and civilian investors to be investing in military veteran VCs. Both Rich and Roy are incredible investors who have been investing in the Valley for decades. Not as long as Pitch Johnson and Bill Draper, but they've been in incredible companies. And I'm really excited to be interviewing them about advice they have for military veteran founders. So Pitch and Roy, if you can please make your way up on stage. Just like the other sessions, I have some questions for both of them. And then as soon as possible, we'll open up to you all to ask questions. If you have a question at any point in time, please stand behind either of those mics. And again, when you ask a question, please share your name, your military branch, and what you're working on. Without further ado, please give a round of applause for Rich and Roy for joining us.
All right, I know you guys just ate lunch, but I think you can do better than that.
First and foremost, apologies. You're probably like, military veterans, you should start on time. You're starting way too late.
Bloomberg, we believe in starting the market. We're starting on time too. Market closes and opens on time, but it's all good.
I appreciate it. And apologies still. I think it would be really helpful for the folks here to learn about what you do and where do you focus on your investing, and what type of, if any, investing have you done either in defense tech, dual use, or military veterans?
Thank you, Tim. First of all, thanks for inviting me. It's an honor to be here. It's really great to meet all of you. Thank you for all of you that have served, and would love to be a resource to be helpful to folks both in this panel, and happy to talk to people in follow-ups or otherwise if that's ever useful. My name is Rich Wong. Grew up here on the West Coast, and I've been at Accel for 18, almost 19 years now, longer than I thought. I thought I'd go back to, quote, getting a real job and being an operator, which I was doing before VC, but I found myself not qualified for anything else other than this after 18, 19 years. Accel has been around 40 plus years. Our kind of claims to fame, I suppose, are consumer businesses. We were the first investor in Facebook, Spotify, Angry Birds, Supercell, stuff like that. We've done a lot of enterprise software. I think software is probably our major, really. Cybersecurity companies like CrowdStrike, Slack. I'm on the board of a company called Atlassian Software. Some of you may know of it, sort of the Salesforce of product development. And then we have started to do work in defense tech and are very much interested in that space. Interestingly, some of that innovation has started to come out of Europe, where the small Ministry of Defenses of each of the Euro countries allow you to sometimes get started quickly. But we have also we've on record of having backed a gentleman named John Tennant, who started a company called Chaos, who is one of the examples of companies that we've backed in the defense tech space.
And real quick, John Tennant, any relation to George Tennant?
Yes, John is George's son, and they're doing a bunch of UAV defense, dynamic radar detection, and John can explain it better than I can, obviously.
Thanks, Rich. And it is really a privilege to be here. Thank you, Tim, for inviting us. And thank you to all of you for your service. So I'm Roy Bahat. I run Bloomberg Beta, which is Bloomberg's VC firm. We are very, very, very early investors. So everybody likes to say they're early stage. Probably a third of our investments are upon incorporation. And we often think of ourselves as day zero investors, pre-seed and seed, if you want to use the language of the Valley. And our firm has been focused since the very beginning on the future of work. That's been the only thing we've done. We're the first firm to do that, and we were also in 2014 the first firm to focus on artificial intelligence. At the time, to be honest, I was skeptical. I thought it was too early, and I was obviously very wrong. And so something that is typical for a lot of early stage investments, and I'll talk about some of the stuff we've done in the space, is we're just really comfortable being wrong. Asking you all to applaud, half of you probably got pissed off. All right, maybe shouldn't have done that. So it goes. So improvisation is a big part of it. And so we've seen some founders who are veterans. So I'll talk about veteran founders outside of anything that is defense related or dual use, and then some defense and dual use. They're just incredible at improvisation. Like, put them in a situation they haven't seen before. And so we invest in a company called Upwage that does hiring-related technology. One of the co-founders there was a Marine intelligence officer. We invested in a couple of software development tools companies, one of which started by a Navy aviation electrician. And then probably the defense-related investment for which we're best known is a company called Shield AI, which was DIU, then DIUX's first contract, and one of the founders was a SEAL. And we've seen companies, we were just talking about this beforehand, start with a commercial market that is outside of defense and realize either that they could serve both markets or expand into defense. So Airspace Intelligence is an AI company that optimizes aircraft flight routes. And they started with customers like Alaska Airlines and United, and then realized. And then sometimes they try to serve both together, and they realize that, it's so different, we really need to focus. So we're investors in a company called Uritz that's much earlier stage that uses LLMs for some internal operations, and they tried to serve both and then realized, no, actually, those affiliated with the Department of Defense are their best market. So we've seen a few variations in the theme. I would describe us as newish to, well, lowish on our level of expertise. Like, there are folks who deeply focus on this, and we really respect them. We don't necessarily need to co-invest with them, but we really respect them. Despite the fact we've had some experience, we're now assessing whether to develop some more expertise in this area, which is part of why I'm here.
Fascinating. And for context for Rich and Roy, if you're a founder, can you raise your hand?
Oh, that's awesome.
Okay.
Awesome.
Hold up. And then if you're a pre-seed founder, can you raise your hand? All right.
If you believe you're building one of the greatest companies in the history of capitalism, can you raise your hand? Love it.
Amazing. What advice do you all have for military veterans that are pitching you? And you might be like, well, that's the same advice I'd give to any founder. But I'm curious, what advice?
We talk a lot internally about trying to understand how the founder created an authentic understanding of the problem. When you think about a business, to get to scale tends to be 10, 12, 15 years. Generally means you're going to be dealing with at least a couple of business cycles, which means you're going to, the competitive environment, the economic environment, the capital raising environment will naturally shift in that 10 to 12 to 14 years. So if one, to pick an example, things we don't like to fund or backgrounds we don't like to fund, if you get the feeling that someone came up with an idea because they read something on TechCrunch and concatenated two of the most popular buzzwords together to create the crypto gamification of the SaaS, if I can understand why you're interested in the problem and why you care about it, that oftentimes is a certain signal for how committed you are to the idea. And it is going to get hard at some point of that 10 to 12 years. So seeing that understanding of the problem, and we think the conviction that comes from after it is one of the key things. If I could just tell a quick story. If some of you may have heard the story of Alex Honnold, who climbed El Capitan, free solo, no ropes, and it looks effing scary, right? It looks impossible from a layman like myself. But we had him speak at some Accel event, and he's like, Rich, it may look like a completely vertical sheet of granite to you, but you get up close and you have, the experience I do, free climbing, you actually can see all the nooks and crannies and the cracks that allow me actually not to be scared to actually climb this wall, in a free solo form. And so to use that metaphor, if you can precisely understand the problem, you tend to have an insight about a seam in the market, about an unfulfilled opportunity, about a segment of customers that you might not see generically from MBA studies or from a general understanding of the space. So sorry to be a little long-winded, but that sort of precise understanding, the authenticity of seeing the problem is at least one of the factors, and we can talk about others.
Yeah, it's funny. I went to the veterans that we've backed and asked them their advice on this question, because I figure, by the way, if you want to get advice on pitching a VC, don't ask a VC. We have no idea. I mean, I was a founder before doing this, and I can tell you the advice VCs gave me on how to pitch was insanely bad, because they're on the receiving end, but they don't have to do the work to give. They don't see the rejections. So I went and asked the founders. And the first thing I realized, so one of them said, well, let's not overgeneralize about what veterans are like, because of course, depending where they served, the nature of the individual, they're as different as any other community. Great and helpful reminder. And I realized that the founders who are veterans in our portfolio, I didn't even realize they were veterans when they were pitching us. And I think in that way, it's very similar to, let's take somebody who's had a career where they've been a big success in the corporate world. They've been an executive vice president at some big company. If they show up and over-rely on their background, if somebody shows up and says, I was an 06, I'm like, okay, I'm gonna look that up after this meeting because I know that that's senior and important, but I actually, unless your background is the reason to invest, it's just that you have to be credible enough. And by the time you get in the room with us, you're credible enough. And I'll give you an example of a background as a reason to invest. When Tony Fadell started Nest, it's like, oh, the guy who designed the iPhone is now starting a consumer electronics company. That's a background that's a reason to invest. I built this precise system inside of my former job, and I'm going to recreate it because I understand it so deeply and I know how to tweak the details to make it better. Then the background is a precise reason to invest. Otherwise, we want you to understand the language and tradecraft of building startups. And it's just a language. And the general advice I give to anybody who feels like they're an outsider is you have so many resources available to you right now to understand the language. And I'll share a quick story, which is we used to do tours where we would take venture capitalists from the coasts to emerging startup ecosystems around the country. We'd go with members of Congress because something we really believe is convening different communities. In fact, Mike Bloomberg has been the chair of the DIB, of the Defense Innovation Board, and we'd go around to these places, and you'd hear from people who just didn't seem like they got what a startup was. And then we're at this tiny, historically black college called Claflin. And I think we were in Orangeburg, South Carolina, but I know we were in South Carolina. And this kid he's a college junior, and he's got a startup, and it's obvious. He's read every Paul Graham blog post. He's read The Lean Startup. He's listened to 20 VC, the podcast. And he's gone deep enough that he's gone past the concatenating two random words because he just heard them and actually became fluent and understood, okay, here's what I need to de-risk to get product market fit, and here's how I keep growing. And if you're able to do that, then whether or not you are a veteran, as much as a citizen, I am deeply grateful to you for your service. As a venture capitalist, it may or may not be relevant to the project at hand, and that's for you to decide.
Love that response and feedback. As you all know, we primarily invest in military veteran founders, and even on our decks, we're just looking for your picture and then a logo of which branch you serve, not first slide. This is a joke now. How do you know someone was in the Navy SEALs?
They tell you in the first minute.
Exactly.
That is also the vegan joke and the you went to Burning Man joke.
Yes, yes. So Roy does pre-seed and seed investing. Rich, Accel, from my understanding, does Series A investing.
Generally, yes. We do some seeds, but I'd say the majority of our business is Series A's and later.
Got it. And so the audience knows this, pre-seed, seed, Series A. But when you do Series A, do you think of investing through the lifetime of a company or not?
Yes, that's correct. I mean, the industry's changed a lot in the past 20 years, and what is a pretty healthy thing from the entrepreneurial community, I'd say, depending how you count on the VC industry has grown 20 times or 40 times in size in the last 20 years. So there are more players to fund more companies than ever before. I know it may still seem scarce in certain categories, but there really is a lot more capital sort of chasing. But we, might tend to write a $10 to $15 million check as our first check to own, 20, 25% of a company, perhaps, and then follow that company hopefully all the way to an IPO or M&A, and we may even invest, at the IPO as well. 15 years ago, we were just the early stage, and so we would let other people support the company in future rounds, and we decided we might as well back our best companies and raise the capital to support sort of from start to finish.
Great. What are some universal truths of startups that you all have seen to be the case in your investing?
What do you maybe say more? I mean, they are new companies
what are
that
some
recently exist.
No. What are some things startups do that will help them achieve success?
Got it. So if we knew reliably, we wouldn't need portfolios, right? And I remember Peter Thiel once got asked what his greatest miss as an investor was, and it was the round that Accel did in Facebook, where he had already been an investor previously, but he was like, nah, I think it's overpriced. So he made one of the greatest venture capital investments ever, investing in them at the seed or whatever they called that round then, the A, and then one of the greatest misses ever by missing the Accel round, which was one of the greatest investments ever. So first thing is, it's more about not knowing than it is about knowing. And so if you think you have a concrete plan, what we talk about is thinking of it as a hypothesis or a thesis plan. What are you going to prove in what order? And the great founders tend to be incredibly fast at showing results by proving that they can get things done. And I'll give you one example. We once had a company that did some supply chain software that we looked at, and we passed. And the same founders came back a month later, and they had made tons of progress. The software looked amazing and what it was doing. They had customer traction. And I asked them, how did you make so much progress so fast? And they said, oh, we just did all the things we weren't sure if we could do. And you see many teams err by doing the opposite. So let me just ask, how many of you here have gotten paid to write software for a living? Anybody? Okay, we've got a couple of tentative hands. I would say, that's really rare. Learn to write software. You can use a thing like Replit. It's not too late, and we're investors in it. But typically, teams that are engineers will over-engineer the early versions of the software. If they're designers, the first version will look so beautiful, but it doesn't matter. If you look at the first version of Airbnb, which is one of the most celebrated design-oriented companies ever, it looks like crap because they knew that they could do that part. And so you gotta focus on addressing the unknowns rapidly in the right order, wastelessly, and that's how you make progress, in my opinion, at least at the early stages. Later on, we can pass it to more experienced VCs with deeper pockets.
I think when I think about the companies that made it, made it to the metaphorical Super Bowl, going public and became extremely valuable, a lot of it is in the dynamic and the culture of the teams. And there's a paradox in this comment where the best founders, the best management teams are warm and charismatic and are places that people, the highest talent people, are attracted to work. For obvious reasons, you want the best talent. But they're also pretty clinical about figuring out when someone's skill set kind of caps out at a certain level. And even if they were the third co-founder or the first head of sales or the first head of products, the first head of engineering, they found I would love to say it was always graceful, but it's not always graceful, where they have the tough conversation to say, we really respect and appreciate your contribution. There is a role for you perhaps still to play this role inside the company, but we got to bring in someone with more experience or can take companies to the next level of scale. And even though we probably generally, in our roles, have the reputation of being very left-brained, the way I can get really excited about companies, I really connect with the management teams and the people. Sometimes even I'm the one saying, you're really ready to move on from Joe? I mean, Joe's the guy who got us from here to here, and I've met his family, and I've taken him to dinner a lot, and we've closed deals together, and we're really going to move on from him. And sometimes I realize some of the best founders, they know instinctively when it's time to make those changes, and it's a very hard emotional thing to do when you've come a long ways with people that maybe you started the company with. But I think that's one of the most important factors for the companies that have really kind of made it to the Super Bowl.
And I'll just illustrate variations in approach. So we invest very early where there's relatively little to diligence about the substance of the business. And I don't know how to tell if a founder is going to be great. Like people say, I meet the founder and I just know. I don't know. And actually, remember, if I can just say another Facebook thing, I don't mean to be like talking all about how great Accel is, but I was talking to one of Rich's partners Andrew, who did the, no, not Andrew, his name started with an A, who did the Facebook, the original Facebook, who did the original Facebook investment? Yeah. And he said, when I met Zuck, I knew he was 1 in a million, but I didn't know he was 1 in a billion. And it's such like a powerful way to put it.
We all make up a bunch of stuff after the fact.
Yeah, sure, of course. But for sure. But my point is, whether that was true at the time or not, the idea that that's how extraordinary you have to be, it's just impossible to know. And the question I ask myself, so in our model, founders are our customers. We sell them money. and then we support them. We don't take a board seat because I'm not the founder's boss. I'm there as a vendor of capital to help them succeed. And by the way, if you want to learn more about us, we're by far the most transparent VC firm. Our website is an open sourced operating manual that shows our check size and our diligence questions and all that kind of stuff. And really, there are only two questions I ask myself about the founder. The first one is, do I trust this person? And I often get at that by referencing them. And so before I've met somebody in person, I've usually done all my backdoor references. I've called the people I trust or emailed the people I trust who know you, if I can find them. If I can't, it's not bad, it's just non-data, to find out what they think of you. And then the second question I ask, and here I'll just tell another story, which is early on in the life of our fund, I came out of a meeting, and we're 3 equal partners in our fund, and my partner, James, was talking to me. He's like, it seemed like you really got along with that founder. I was like, yeah. And I had been a CEO and a founder previously, just before. And he said, sounds like he's the kind of guy you want to hire to work for you. I was like, yeah. He's like, nope, that's not who we invest in. We invest in people who you want to work for them. And so the second question I ask myself is, do I want this person to be my boss? And we've had this question a bunch of times where we'll be like, I just don't feel excited to serve this person. And so they might be great. They might create one of the greatest companies in the history of capitalism, but we want to serve them. And I'll just say, the kinds of things we're proud of are results like 91 people who we've invested in have become millionaires. 22 of them have made $10 million or more. And that's the kind of thing we want to be able to set them up for.
Bloomberg Beta, open source, I think it's on GitHub. So when folks say, hey, it's very opaque, it's very difficult to get in front of investors, if you go to Bloomberg Beta's site, you'll see they've got all that information, as Roy mentioned, check size and what stage they invest in. I bring that up because when we kicked off today, we interviewed Chuck Templeton, Army guy, started Open Table, and he mentioned that when he was fundraising, he stalked his investors. He had to meet hundreds of investors, and he stalked Bill Gurley until Bill Gurley figured out that it was a good opportunity. A very tactical question that I'm sure founders want to know: how do they get in front of you? How do they get on your radar?
Yeah, so ironically, even though we're really transparent, we do not make it easy to get in front of us, because then you just get a lot of garbage. And the way we think about it is the investing process should look as much like the company building process as possible. It's not always the case. But if you're selling enterprise software and you're sending me a cold email, I'm like, well, are you going to send a cold email to your next prospect? This is no different from that. And so the best way to get in front of us is to imagine what it might look like from our perspective, and I'll give you a little hint as to that, and then figure out a way to show up so that the second we've heard about you, you sound like you might be creating one of the greatest companies ever. And so it's not just a warm intro. It's a warm intro from somebody who we trust to have judgment about founders. So I love my college roommate, but when he's like, I see this company and it looks really good, I'm like, okay. Whereas if it's a founder I invested in who is themselves building one of the greatest companies ever, and they're like, by the way, I love this so much I angel invested, I was like, well, Dan Mannion is the founder of a company that we co-invested with Accel. If Dan sends me a deal, it is going right to the front of the line, because Dan knows what greatness looks like. And so you have to arrive in the person's field of vision in a way where you immediately read as extraordinary.
Yeah, I would just add, so we'll try to meet with everyone, and we have teams of associates and younger VPs that will meet with folks. I'm not sure that's the best use of your time, to be direct, because there's a very specific matching of which are the opportunities that we'll eventually fund. And sometimes our young people, they want to report to the partners that have had a lot of meetings. And I think it's just really important to qualify it yourself to make sure it's a firm that's realistically going to do the deal versus someone who's just trying to notch that they got another meeting done, which does occur in the industry. Let me give a couple of additional suggestions about a good way to do it, which is when you're starting a company in a certain space, inevitably there's almost always some other set of companies that came 5 years before, 10 years before, 15 years before. Maybe 2 of those generations were successful and 1 was a failure. If you're likely to be successful at this, you'll probably understand the twists and turns of what went well or what went poorly about those that ran before you a mile or 2 or 3 miles ahead of you. The best entrepreneurs I find a way to convert those previous folks to become investors, advisors, or to help you in the business.
It's a great tip.
They know the category. They may even have some of the contacts. And realistically, we on the money side, we're going to call one of those people to diligence the idea if they're not already in your camp. So why not make it easier? Why not both use them to get advice about how to maneuver the business, but also they're the strongest reference you'll ever have when the money person that only knows so much, comes around. And I think what you'll find is that entrepreneurs that have done this before, maybe they sold their company to the larger corporation, they're very willing to give advice. They're very willing to help. And it's another test, as Roy just said, of do you sort of have the grit and the creativity to get in front of those folks? Because if you do, that's a very good sign for getting the next 1,000 customers you're going to have to get. So that's a small thing that we look for.
I think that's, first of all, it's really rare for somebody to say that who sits in your seat, because you got armies of people who we are actively telling founders we've backed, if Rich's associate wants to meet with you, do not take the meeting, because you will read as somebody willing to meet with Rich's associate instead of with Rich. And that is really awkward. And the great founders know how to navigate that kind of stuff with nuance. And they find the simple things that end up mattering. And an example of a simple thing that ends up mattering a lot is the format of your slides. So, for example, there's a convention that in the private equity industry, things are sometimes vertical. And in the venture capital industry, things are sometimes horizontal. You can break that. Plenty of great companies have. They write a memo instead of a deck. But you should know deeply what the conventions are and break them with intention, because they are easy to figure out. They're really easy to figure out because it's all over the internet now. Unlike when we got started in this, and Rich started a little bit before me, it was not easy to figure this stuff out. So avail yourself.
Yesterday, our very first session, were 3 founders, military veterans who are basically have achieved escape velocity, one breathe, farther, 0 eyes. And the advice they were giving to the founders in the audience is that you shouldn't feel like you're just purely selling, but you're also giving the investors an opportunity to go with you on a journey. And so
Sure. I have no idea what that means, but fine.
And so as part of that, I'm curious, and you all might find this to be a silly question, what's the reverse pitch? Meaning, like, what does Bloomberg Beta or Accel provide to founders?
Yeah, for sure. I mean, we work for you to try to raise the odds of you creating one of the great companies ever. And the first thing I just say is, whatever I'm about to say next, don't listen. Call the other founders that we've backed. They're publicly listed. They're my customers. I stand behind my reference for every single one of them. Not only do we measure ourselves primarily through a net promoter score, so their customer service rating of us, we actually work to try to create a service that ended up not taking off, where founders who had been backed by multiple firms could say which of those firms they preferred, as a way of force stack ranking all of the various firms. And the real answer is, at our stage, it's the call us for anything people. We are not going to sit there and be your boss. We're not going to meet with you once a month unless you ask us to. But when the oh shit moment comes up, where you're like, oh, the New York Times just heard that my startup exists and they told me they want to write a story about it, what do I do? Oh, a competitor with a similar sounding name just sent us a cease and desist letter asking us to change our name, what do I do? Oh, the corp dev person, corporate development at a potential acquirer just sent us an email asking to meet with us. What do I do? Hit delete. It's those kind of little moments that end up being a lot of the tradecraft. And I remember a senior executive from Bloomberg was once visiting in our office and overheard me on the phone talking to a founder. And he's like, well, can't you scale giving that advice? Like, it seems like that's really basic stuff. But the truth is, wild success as an entrepreneur often involves careful tradecraft on the basics, and I don't want to scale my business. We've had the same fund size since we started. We're now in fund 4, because those moments of getting that tradecraft of the basics right, that's how you excel.
So, sometimes we say this comment humbly, and sometimes we say it arrogantly, but I grew up in Santa Rosa in a pretty rural area, and I'd say, after 40 years of wandering around the fields, we've stepped in every cow patty possible. We have seen every mistake. We have made mistakes ourselves. And to the more arrogant side of it, we've seen a lot of success as well. And so we try to share as best we can through the CEOs and the VPs of engineering and the CROs that are a community across our many companies, both the successes and then the what not to do. And we think that improves the chance of success.
So please start lining up behind either of the microphones if you have any questions. I have a number of questions for Rich and Roy. One of the preconceived notions, at least when I got in the Valley in 2010, was that every VC is the same. And you all are so different in terms of all partners, a team, and then you all have not just a team, but like a marketing team, hiring team, and so on and so forth. How do you think, well, where do you think venture is evolving, and specifically, how does that apply to founders? Because venture is, I think, changing in terms of mega funds, emerging funds, but more specifically, how does this apply to the founders?
I think the concept that firms like mine are growing up to have more and more personnel and more teamwork, it can be a positive and it can be a negative. And I think it's important for each founder to decide what is the right fit for them. Let me just try to share some of the good and the bad, where we still have a model where the lead partner is the one responsible for being in 95% of the meetings, where not just the board meetings, but PR strategy, marketing strategy, actually interviewing the CRO and VP of engineering. This used to be the case for 100% of partners back 15 years ago, but as the industry has scaled, more and more of this is delegated to staff inside of the venture capital firm. In some places, I think it's gone so far that the partner who's supposed to be your lead consigliere and advisor is no longer really at the center of that discussion. They're just playing a part in the kabuki theater play, and they're coming in for their part, and they say, God blesses everyone, and then they go back and do their next thing. And that is not a good model in my view, where you're giving up a fair amount of dilution, we hope, when we negotiate, for a certain amount of capital. The return should not just be the capital. It should really be useful and strategic advice and introductions. And when I think it gets subbed out to all the subcontractors, that's not a good thing. So I would broadly say make sure that try to figure out who your trusted person is going to be and who you believe is really going to stick with it, not just for when things are easy, but also during the tough years. And as Roy said, interviewing previous founders of that specific partner, of that specific firm, is the best way to get a sense of it, whatever we say from a marketing perspective.
Yeah, we've got a blog post on how checking references for an investor is different than for a hire. Because for a hire, you're just trying to get a sense of how high quality is this person. For an investor, you're mind sweeping. And so you got to do a lot more calls, and you got to look for the situations where things went sideways. And the thing I focus on is actually what hasn't changed, because yes, big funds are getting bigger. We've stayed the same size, just even though it's financially irrational for us. We have the same head count. We like being stable so that you don't have to worry about our change. You can worry about your change. And here's what hasn't changed: excellence. So working with a VC firm that has a reputation for having backed some of the greatest companies ever is really important. The second thing that differs a lot is the community of founders, because ultimately a lot more of the value that you'll get will probably come from other founders than directly from the investor. And so if you can be in community with founders of companies like Slack and Flexport, and I mentioned Airspace Intelligence and Shield AI and Masterclass and ... that can be incredibly valuable to you. And then, I would say though, the part of it that's true, Tim, is most VC firms, I don't want to say they're kind of the same, but you want to treat them kind of the same. And here's what I mean by that. So we have a tiering system. Tier 4 is the worst. It's unethical. Don't talk to them because they'll steal your idea and blah, blah, blah. And in Silicon Valley, I'd say there's very few Tier 4s. Outside of Silicon Valley, there's more, and some places it's almost all Tier 4s. Tier 3 is they're bad. But if you need to take their money, you can take their money and it's okay if you have no other choice. Not that much Tier 3. Most VC firms, I would say, are Tier 2. And Tier 2 is they'll be totally fine. They won't harm you. Try to manage down the amount of time you spend with them. But in that case, treat them all as kind of the same. And then Tier 1, and Tier 1, we aspire to be in Tier 1. Accel is in Tier 1. Tier 1 firms should only lose to each other. And if you can get one of them, get them, because they can help put your company on a higher trajectory. And so the vast majority of VC firms in Silicon Valley, I'd say, are Tier 2. It really doesn't matter that much among them, and manage down the amount of time and nuisance you get from them, and otherwise just go do your thing.
May I just add to that for a second? I think, I happen to have a couple kids going through the hell of college applications right now.
Oh, I have a junior, so you can tell
Some of
me.
you may have similar experiences, have gone through the hell of that process. You know, there's a fixation around like U.S. News and World Report. That's probably not the right way really to look at it when you think of the right fit for your particular kid in a particular situation, right? So, yeah, I guess it's good to have the bumper sticker or the sign or whatever if that makes you feel good to your neighbors or something. But really, it should be the right kid fit, the right school fit for the right person is what really matters. To use that analogy, I think that applies in this world as well, where there is, I believe, some level of who's high quality. I have a similar set of companies in my mind of who's good or who's not. But what really matters for the entrepreneur is this particular firm and partner right for your specific idea? There are some, we're pretty good at certain things. We're not particularly good at retail. We just don't know anything about building retail stores and how to scale that out. There are some people that are brilliant at that. That's just not us. And so I think, not to use too many analogies, but there's different firms for different stages and different types of businesses, as opposed to just fixating on the top 10 ranking, which isn't really, in my view, the right way to look at it.
Yeah, sorry, I should say the tiering system is by firm and by stage. And a particular thing people do is they look at this thing called the Midas list, which is a constructed list of VCs with great returns. There are many great investors on that list. There are many people who, if a founder called me, I'd be like, do not let that person on your cap table because they will ruin your company. And so remember, that's about their returns for LPs. You want somebody who's going to be working for you.
We're both pre-seed investors. What do you expect to be doing for their founders? So when we talk to pre-seed founders, we tell them most of the time, like the most valuable help we can do is introductions to seed and Series A. But do you think pre-seed founders or pre-seed investors should be doing customer introductions? Like, what's the extent
definitely.
of? Yeah.
I mean, I guess here's what I'd say. What won't we be doing? I mean, I have referred divorce lawyers. I have helped somebody figure out how to get their kid transferred to a school that was closer to where they are so that they could focus on the startup. I have done endless customer introductions. And to me, the question is just what's the highest and best use? The great founders know that starting is much simpler and they just get going. They don't overplan. They just plan just right. And what they do is, like one thing I say is starting a startup is really different from school. So in school, you get a test and it's got some questions and you are graded based on how completely can you answer all the questions correctly. Startups is more like instead of 100 questions, there's 1 million. And you are graded based on can you pick the one question that matters while the other 999,999 of them are screaming at you. Ignore them all and give that one question the best answer that has ever been given. And the corollary of that is shit breaks. Stuff comes up. Somebody is angry and sues over whatever ends up breaking. Our job, in a way, is to just help fix the stuff that breaks.
In 2020, and real quick, I'm going to ask Nick and Ishan to ask a question because they've been asking me a ton of questions, so now they can ask it to other investors. And Clark, I also want you to ask some questions too, for the because I don't want to be the only person. And we've got Rich and Roy, and they have a ton of experience. In 2020, a ton of capital was being deployed. 2023, 2024, a bit of a dry spell. Have you all been consistent with your deploying? Do you think this year is going to be a bit more, a little bit less, or it's just like play it by ear, or no, you have a set cadence?
It went up and down a little bit for us, but because we have constant size funds, I mean, the fund size really governs on this. The thing I'd say we noticed in our portfolio companies is during those boom years, we were like, we must have missed something because so many companies are not getting marked up that we were involved in. And that's because we tended not to focus on the companies that grew at the expense of company quality, because the single metric that matters more than anything else in Silicon Valley is how fast are you growing. But there are plenty of companies that have upside down unit economics. They lose more money on each customer than they make, or are growing unprofitably, where they're putting in $10 in order to get value of $8 through marketing or sales or whatever other channels. And we tended to avoid those. And that means that we didn't enjoy as much of the up, And we didn't, when the bottom fell out, it was like, no, they're actually pretty healthy businesses still.
I think it's going to be a very active and very good 2025. I think you're going to see it across the board. Whatever one's politics, I think you have an environment where the FTC is going to be willing to support certain more acquisitions and combinations that were not so much easily the case the last 3 to 4 years. And I think that starts to get the money flowing through the system. Returns start to come back, and then as a result, the aggression comes back from a VC perspective in deploying. We did slow down in 22 and 23. I think we were glad we did because the valuations had not come down to reset with the commercial status of those businesses. And now I think things are coming much more in line. So I think both on the exiting side and on the deploying side, I think we're going to actually have a very good year. The amount of IPOs I think that will start to occur this first 6 to 9 months of 2025 is really starting to ramp up. And so that's going to be another visible sign that I think we'll all see.
Great, and then that's the recycling of capital, and then coming back to GPs and maybe emerging managers. But more importantly, Clark.
Hi, thank you for sitting on this panel and for giving your thoughts. My name is Clark Yuen. I'm the founder and CEO of Stitch 3D, former Army intelligence officer, and also did 4 years as a reserve officer in innovations.
Say the name of your company again?
Stitch 3D.
Stitch.
Share what your company does.
Sure. Yeah, so it's a SaaS platform for 3D visualization analytics, specifically looking at LiDAR-generated point clouds and making that very accessible and shareable on the web.
They're trying to build the box meets Figma for 3D images.
For what images?
For 3D images.
Yeah.
What use cases, sorry to make this, what use cases, give me a quick example, please.
So specifically, it's right now targeted at the service providers who are going out there and collecting the 3D images for an oil and gas company, a construction company, a forestry company. LiDAR is just an imaging device. So it's like asking, what can you use photos and videos for? There's a lot of use cases. The challenge right now is that all this is being visualized on desktop software because the web just has not been able to handle point cloud formats for a while until now. So we're building a horizontal platform first to serve these small businesses, to distribute that data to their clients, and then eventually building tooling for those industries.
Thank you.
Yeah. So my question is going back to your discussion on tier 1, 2, and 3 VCs. How should an early stage pre-seed seed company think about that in terms of the weight of the value they can bring, specifically around like institutional VCs versus a corporate VC versus a family office? Is there a difference in terms of like who you take money from that can posture you for success down the road?
And this might be TMI, Clark, but Clark has an offer from a family office.
Got it.
Yeah.
So the first thing I'd say is before any of those, and it's something Rich was alluding to earlier, angel investors who know what they're doing, like dollar for dollar, the founder of a relevant, successful venture-backed company is going to be more useful, all things being equal, as an investor than any firm. And so depending how much money you need, sometimes those folks have, like their own huge funds actually that they keep in reserve. And so you can approach them. Second thing I'd say is less important to me than what, I'll answer your question directly, but less important than what type of investor is, have they been an investor in some of the greatest startups ever? And if so, what is their reputation with the startups they've worked with? If they haven't been, if it's like, the kid of a real estate family from someplace that they're like, I'm going to be an angel investor. It's like, that's going to be very dicey.
Avoid the nephews.
Yeah,
the nephews.
no nephews.
Nephew running
no
family
nephews.
office,
No.
bad son.
Nieces are okay as investors, but never nephews. And then beyond that, I think I'd say one of the reasons I practice my occupation is I think you get better at it. And so we don't think of ourselves as a corporate VC firm because we invest to make money. We have standard carry. We don't care if you work with Bloomberg or anything like that. In fact, only 4 people at Bloomberg are even allowed to know what we invested in before it becomes public. So we think of ourselves and are just a regular VC. The money we generate, other than the part that the partners keep, goes to fund Bloomberg philanthropies. So that's a difference from a regular VC, but still. And I think being a professional is a good thing. And so find people who are professionally experienced in starting to help companies. That tends to be more important. Last thing I'd just say, an error people make is that they want domain experts. Domain experts as investors, so like you're doing something that serves forestry, can you find a forestry person? It can be helpful. It's usually helpful significantly later. In the beginning, the fact that they don't really get how startups work usually outweighs the fact that they may understand how the industry works. But a lot depends on the individual.
I agree with what Roy said. There's just two frameworks to think about it. Bottom up, I'd say, not to be too ex-consulting about this, but I'd sort of map it on
We're both former McKinsey, aren't we?
who are, on a scale of whatever you want to say, who knows something. I don't care if they're family office, I don't care if they're VC, they could be pre-seed, who actually just knows something about the space. Let's say you're doing something in automotive. The Cox family, which is a family office, a huge family office, that they own obviously a lot of media properties, but they also own a ton of automotive assets. And so if you bumped into the Cox family office, that's a very different type of family office than the nephew family office, for example. So I wouldn't overly characterize by class. I'd categorize by who actually knows something about the vertical. On the other axis is how much money do they have realistically for what degree of difficulty. You don't want to spend all your time with someone who can only write $250,000 ever because you might need more money in the next rounds of capital, et cetera. So I think that's one way to look at it. Another way to look at it is parallel to what I said before is look at the things that are most adjacent to what you're doing. And they don't have to be exactly in the same space, but maybe it's industrial equipment serving a certain set of verticals, and you take the superset of all those businesses, who funded them? And then what are the people that had good experiences or crappy experiences with that set? Ideally, if those two map together, I think your answer is going to be with those two frameworks. Happy to help or talk about it afterwards if it's useful.
Yeah, very helpful. Thank you so much.
Nick, Ishan.
Hi. When someone does get in
Wait, introduce yourself,
Who are you?
please.
Hi, I'm Nicholas Kowalski. I'm with Perspectives Health. We're doing AI documentation for mental health, focusing specifically on substance abuse right now. My question is, once someone does get in the room with you, assuming they did it in an impressive way, how quickly are you making a decision about who that founder is? And once you've made that decision and you've worked with the best founders, how often are they actually coming to you asking for help?
I'll answer the last question first to say, I hope constantly, the way I didn't answer the earlier question, but what we aspire to be is the first phone call. Like when there's a problem, when there's an opportunity, a big deal to be done, PR crisis, we may not have all the answers, but we think we've seen enough successes in cow patties that we know what to suggest. And so we hope to have that relationship of trust where it doesn't always happen, to be honest, but I think a good percentage of the time we just want to be the first phone call and help how we can. In answer to your first question, maybe it's sort of 20-20 on the ends and on 60 in the middle, meaning, maybe you're pretty sure when you don't want to work with someone for whatever number of reasons, maybe 20-25% of the time. And sometimes you have the instinct, maybe you've done tons of pre-work in the category, and you're like, well, we really already bought into this idea. There's something that's going to work in this area, and then you find the right human being that you really want to partner with. That's another 20% of the time. The rest in the middle, it depends. Sometimes there's diligence work you have to do to try to figure out if you believe in the space. Sometimes the founder is making a technical assertion that they've created this step change innovation, and you're not smart enough yourself to know if that's true, so you got to call up your PhD professor friends or to say, well, is this really true? You call up your friends at Google on this area of AI innovation. And so I'd say it's 20-20-60, and we try to get back to people as quickly as we can, but sometimes it takes 30 days when you ultimately, if you really want to run through all your questions.
Yeah, and I'd say, I think the question about how quickly, it's a little bit like I showed up on the first date. How soon am I going to take this person home? And it's like, it varies a lot. And so I just say, we've had cases where we've said yes in the room in the first meeting, but that was a pre-existing relationship where we knew the space really well, we'd done what diligence we needed to do. I've had cases where I said yes later that day. Flexport, I had just a shipping broker. I'd used a shipping broker in my previous startup. We heard a lot of things we liked in the room. We'd done our diligence on the founder before. I got back to my desk. I called their customer service line as a customer because I was still chairman of that startup. They were so good that I was like, damn, if the customer service person is this good, I mean, the customer service person was like, I know we happen to be fundraising right now. You sound like you're both a potential customer and a VC. Should I pass you to our CEO? And I was like, holy shit. Please sign me up to invest in that company right now. And then we've had cases where it can drag on for months because there are reasons. The person changed what they were doing midway through the process. I would say the mode is that it tends to take us at our stage 1 to 2 weeks and 1 to 3 conversations with you. We tend to put our customer calls, if we need to do them, last because that's very expensive for you. Like, you don't want all your customers talking to people. And so by the time we're getting to that, we're pretty convinced. As far as how often people call for help, so one of the reasons that we kept our fund sizes small is so we can invest early, because with all due respect to the great Series A firms who are the first call, is the founder calls me and they're like, okay, I'm going to call the Series A investor. They're going to be my first call, but what do I say to them? And so I'm talking to them before that first call and helping them strategize because they know there's a consequence in terms of follow-on funding, even in a high-trust relationship. The mode there tends to be spiky, which is there are companies we don't hear from for 6 months. I mean, hopefully we get a monthly update from them, but then something happens. Their sales mechanism isn't working. They all of a sudden lost their whale customer, and then you go into emergency mode. And what's changed a lot over the last few years is the variety of channels. So most of the startups that we are very close with, I'm in a text group chat with them, and that's where we're handling a lot of our stuff. Yeah, sometimes I talk to them. I have almost no regularly scheduled meetings because, like, I don't know, what's the point? So that's just gives you a feel for it.
Can I just make a very tangible example, which is, so you're in the mental health space. If you were to pitch Accel, who's the likely first person I'm going to call? We backed a company called Headway. Andrew Adams, local kid, Stanford. He's doing pretty well. And so ideally, you get him to be your angel. You give him some free options also to buy down his entry price to convince him to do it. And if he then walks in and says, hey, Andrew calls me, or the partner who actually led the health investment, he says, hey, I really believe in these guys. In fact, I'm investing personally. The probability of us taking it seriously and then actually getting there probably went up 10x in that. And so I think every firm probably has a touch point in some way to what you might do. And I think if you can look for those touch points in advance, it doesn't guarantee it, but it improves dramatically the probability of us
I will say,
getting
I think Rich is so right in that we know all these firms. But the number of times where we've co-invested with one of the great firms where we were the ones who made the introduction rounds to zero. We will tell the founder, you want Accel? Go find a founder who is successful for Accel, ideally as relevant as possible, and convince them. Because if I'm introducing to Accel, Rich knows they're in a process. I'm sending that email to 10 other firms. And I think VCs are asking themselves, look, it's really important to get in the headspace of the VC. A VC at a bigger firm, and if you disagree with this, you could tell me. What are they asking themselves? The first question they're asking themselves is, should I do more work on this? And what that specifically means is if I bring it up in my next partner meeting with my partners and I only have a moment to make the case, will my standing within the firm go up or down? Like, will I look good to my partners or not? They're not thinking about what the ultimate exit is going to be, not yet. The second thing they're thinking about, and by the way, at our firm, our policy is any one person, including my admin, can say yes to a deal so that we don't have to worry about those dynamics. But we're also an earlier stage firm. We write lots of small checks, so it's a different strategy. The second thing they're thinking is, why me? And if you have a founder who has been broadly introduced to the whole VC world all at once, they've gone around South Park and seen every firm in South Park, then each person has a bit of the bystander effect. They're like, well, I have to be much more confident. Whereas if it comes in through a founder they've backed, it feels proprietary to them. They're like, ooh, I have something special here. So that's how you get in the headspace of the VC.
Steve, who's working on a future of work company, I want you to ask a question after this question that I have, and that is defense tech and dual use. We had a session yesterday on, is it cyclical or is it systemic? Where are we?
Is it a what or a what?
Is it cyclical or structural?
Oh.
We're still new in this, so we're still figuring it out ourselves. But I do think it's structural, not just it's secular to a degree, at least for the next couple of decades. We are still trying to figure out if we understand the purchasing behaviors of all the different branches of the DoD and all the acronyms that make everyone's eyes roll back in their heads. To be able to predict which we think are the winners, but I absolutely think it's a large money-making opportunity. and necessary for the defense of our country.
Yeah, and I'm not sure if it matters because if it was cyclical, the cycle for this is so long, unlike, let's say, the creator economy, that if the cycle's the rest of my career, I don't care if it's a cycle or a sectoral or a structural change because I can make money doing it. And so either way, there seems to be a clear opportunity. I'll just say it seems that the way that the buyers look at the primes is shifting. They're like a little less, you only get fired if you work with the right primes. But we're also learning our way here. And the role that Congress plays is changing and ...
Hey, thanks, Tim. Roy, Rich, nice to meet you. Steve Gilman, co-founder and CEO of OneRange, AI-curated skill development platform, highly effective with companies in training their employees. Roy, I know Karen really well out of New York.
Yeah. Awesome. My equal partner, James and Karen, my 2 equal partners since the beginning.
Awesome.
What types of training categories?
Yeah, so basically we allow any employee, knowledge workers mostly, to select the type of training they need globally across any format. So a marketer that needs to pursue their goals and skills, an engineer, GC, what have you. So really it's across the board. It's a marketplace approach to allow employees to find what they need. So we find it really effective in making HR heroes and employees actually getting the tools they need, which has some pretty interesting user behavior that I think is pretty groundbreaking. Rich, I get hit up by an analyst from the New York office all the time to talk with me. I haven't spoken with her. I'll find her name. But curious as to what you're seeing changes, or maybe there's some stability in what you see as Series A metrics, right? Kind of the first check out of where Accel is and what that looks like for an enterprise SaaS company.
Yeah, great. Thank you. First of all, there's a lot of variance, so I'll try to give a generalized answer, but there's really a lot of, I think to the degree that they're the first pocket of customers and, maybe enough ARR that rounds towards 7 figures or is 1, 2, 3 million of ARR, that's a nice place to be. I think we actually do Series A's with nothing, too. We do Series A's that are 2 founders with an idea we really believe in. It probably does help if one of them is an alumni of a previous company or was a second or third time founder, but we will back ideas that are with just ideas, but probably 1 to 2 million in ARR is what we look for.
And I'll say, from the perspective of coaching people pitching, I actually think the metrics is the wrong question. Because we've seen companies get to 5 million of ARR and struggle to raise an A. We've seen companies with 50K have a wildly competitive A. The problem is that the question about any achievement, let's take a metric, is what does it indicate about the company? You can get to 1 to 2 million of ARR and have a great company or a shitty company. Therefore, it's not a useful metric. And so instead, the thing we think about is what have you proven? So typically, by the time you're getting to Series A, again, unless there's an extenuating circumstance like you're Tony Fadell and you invented the iPhone or you started the last Excel company that went IPO, set aside the extenuating circumstances, you have product market fit, you have begun to figure out how to grow, and so you've got good unit economics, customers who love you in one form or another, and you've begun to figure out how to grow. That tends to be when the great Series A firms start to show up.
I would agree with that. And if I could just add, there's an additional point. But sometimes you can decompose those from the existence of those metrics. But it's right to say it's the narrative, not the number.
Well, let me ask you a question about that, Rich. High ARR, slow growth, versus low ARR, fast growth. The metric that matters is how fast you're growing. And by the way, companies that quote year-over-year growth, I'm already not interested in. They're thinking the wrong metric. The companies that quote month-over-month growth, okay, now we're talking. The companies that quote week-over-week growth, not every business is like that. Sometimes you're doing enterprise sales, and that's not an appropriate, you don't have the scale yet to think that way. But if you can think that way, it's like, damn, you're growing, the faster you're growing, if you have good unit economics and the customers love you, the more interest you're going to have.
Ishan.
Love it, thanks.
Hi, I'm Ishan, also with Perspectives Health. One thing I thought that was interesting in the Bloomberg Beta manual was in the
Thank you for reading it.
You're welcome. in the factors about what would bias you for or against a company, you talk about cognitive distortions of founders, and I'm kind of interested by what that means. What are some cognitive distortions that you do want to see?
Many of the greatest founders, it's funny, as Rich was talking about like the warm, charismatic founder, I was thinking about Zuck. he did not have much warmth. That guy is, and I'm not going to say about any one person in particular, but many of the greatest founders are kind of sociopaths. Like it's weird, they're ethical sociopaths. They just don't feel feelings the way that you or I do. And when I was a founder, it was so hard. Like we had an investment firm cancel their Series B term sheet on us. We had 2 weeks of cash left. It was a Chinese corporate. I'll just say it was Alibaba. They canceled their term sheet on us the Wednesday night before Thanksgiving. I am not enough of a sociopath not to cry when that happens. But there are founders who will just be like, okay, wake up the next morning and start texting your VCs or whatever it is. And so the cognitive distortion of founders piece, which is a Michael Deering presentation, which I thought was great, was really about the paradox that they can do black or white thinking, and then they can, like absolutist thinking, but then they can also see the nuance. So there's a lot of paradox in being a successful founder, and that's what we mean.
Good to know.
I know you meant it slightly different. I don't think everybody has to be a sociopath to like.
I didn't say that.
Be successful.
No, I just want to be clear. I said some of the greatest founders ever are sociopaths.
Yes.
Not that every founder. And I
do
do think
see the
it's
world
easier
differently. Yes.
if you're a sociopath to be a founder, and that's a bad thing. It's part of the reason why powerful companies often do awful things. There are some of the most successful companies ever who are some of the most empathetic, humane, caring people. It's just more difficult.
Roy on LinkedIn is great to follow, by the way. He has some hot takes there, too.
Hi, I'm Adam Harder. I'm the co-founder and CEO of Impress, which is a news-powered dating and social network that launched in DC in August and is launching in New York City on Valentine's Day. The question I have for you, actually, I'll just start by saying, by the way, Rich is a former broadcast journalist. If you ever get tired of VC, you have a great voice for radio, so you should think about it.
There we go.
Got you.
He may be the only VC left who hasn't started a
Voiceovers is my-
podcast.
if this doesn't work out, voiceovers.
Okay, here you go. Though that's being taken by AI, so maybe not. No, my question is actually relating back to something you guys were saying earlier, which was kind of playing into the bigger dogs in the industry that you almost basically seek to disrupt. And I think we find ourselves in this interesting position right now. I kind of call it our awkward teenage phase, where we're now in market in DC, about to go to New York. We are a B2C business to start before we get to the more lucrative B2B model. And I guess right now, we're getting reached out to by the Atlantic, the Journal, the Times, asking if they can put our content on our platform. But frankly, we're too big for we're not ready. We haven't even built out that technology yet because we're consistently focusing on our B2C end users. And I guess I wonder how you guys think about at what point does that calculus change, because it's not a priority right now, but
Sorry, at what point does which calculus change?
the calculus change of maybe we should actually, because we're a small gritty startup, right? We're not a big team. So at what point should we stop focusing on our end user, our main customer, features that's going to make the app stickier and actually pander to these big journalistic players that we don't necessarily need, but certainly would help to have?
Post-IPO.
Oh, great. Okay, great.
I mean, I'll just say, I'm being a bit flip, but the only religion I really have when it comes to startups is focus. And something that helps is not good enough. It is additive, not good enough. Can you succeed without doing it?
Yes.
Is it necessary to so fuck them.
Love that answer. Okay.
Last question, and then we're going to ask High Ground to come on stage.
Awesome. Thank you, gentlemen. My name is David. I am the founder of Palm, an AI-powered career co-pilot. I'm curious, you've talked a lot about your interaction with founders, and I'm curious as to what does it look like as how would you think through as a founder going direct to pre-seed VC and having those conversations, or going to an accelerator in that place? And specifically, Roy, I know you mentioned that you coach your founders, so I'm curious as to like how you think.
Yeah, I don't know that there's always a right answer. I think it depends on the business, but those also aren't your only two choices. I think founders often think that those are their only two choices because that's what's easily available when you read on the internet. Find successful founders of relevant venture-backed companies to angel invest in you, and whatever they tell you is 10 times more likely to be correct than whatever I tell you.
I agree with what Roy said.
Awesome. Thank you.
Yeah, thank you.